morning, everyone, and I hope everybody had a great time at the Getty last night. This is day 2 of the Montgomery conference, and appreciate everybody showing up early in the morning for what I think will be a really terrific panel with 3 amazing investors. You know, yesterday we spent a lot of time hearing from not only founders, but venture capitalists, even LPs, you know, with Michael Milken being on stage. And we heard about where they're investing and how they're investing, the institutional side. This morning, we're going to shift gears. We're going to move into the corporates and why they're investing, where they're investing, and how they're investing. I think for a lot of folks, and for me as a founder for 43 years in the Silicon Valley, I always looked at corporate venture capital as being mostly growth stage, sometimes late stage, kind of risk adverse going forward. It's a bit surprising that in 2022, 24% of all the capital put in play was done by corporates. What the most interesting point was that it was done, 62% of that money was done early stage, which makes more sense to me as a founder because the strategic value of these 3 companies and others in the corporate world for founders is unique. The ability to bring deep market intelligence, industry knowledge, technology architecture for us founders really helps in the product market fit phase, which is the earliest stages of all of our paths. And so this move or this shift to the early stage is, I think, a profound change for the corporates. But if you do it right, from an engagement model for founders, it could be market makers. If you do it wrong, it could be death by meeting. So today, I've got 3 extraordinary investors for 3 extraordinary companies. First, Barbary McCann from Workday Ventures. She's Senior Vice President of Investments there. And for full disclosure, Barbary and I have done 5 investments together. And I deeply appreciate you being here, Barbary. Keith Kirk from ServiceNow is the Senior Vice President for ServiceNow, but does both venture and corp dev along the way. And then we have Gore Talpaz from Crowdstrike. What strikes me about this panel that we have is all 3 of these companies' founders could have presented at the first Montgomery conference 20 years ago because they all went public in the last 20 years. And now they're investing in new companies in the next generation as we go forward. So let's jump into it. We got only a short period of time, so I want to get into some questions. I think the most important question is why? Why do corporates invest? You know, there's all kinds of different reasons. There's financial gains. Institutional investors are looking for financial gains. There's strategic value. There's differentiated value with clients. So Barbary, why is Workday investing?
Sure. So we started our corporate venture in 2018 to be an innovation arm of Workday, to really accelerate innovation around and with Workday. And so it's been very successful doing that. We have 46 companies in our portfolio. We still are strategic, but we have done well financially. So we're kind of moving into a hybrid of strategic and financial, but our number one goal is to really accelerate the businesses of startup companies around Workday and extend the value to our customers.
Keith, are you doing it any different, ServiceNow?
Yeah, so ServiceNow has a pretty similar philosophy. We've been deploying capital in high growth companies and private companies for quite a while. We've got a portfolio of about 30 companies between $200 to $300 million that we've deployed off of our balance sheet. And for us, it's as much about making sure that we are at the tip of the spear in the innovation conversation with our customers. And when you think about the 4 or 5 big workflows that ServiceNow is building, whether it's IT or employee or customer or low code, no code, each of those touches 3 or 4 big market trends. And so we're using our balance sheet to really build that ecosystem around all of those customer needs so that we can have a richer conversation with solving our customers' problems.
How about you, Gore? How about
Yeah,
Crowdstrike?
so it's a little bit different for us. We launched the Falcon Fund about 3 years ago, roughly speaking. I took it over about 2 years ago. Initially, it was conceived as sort of this early stage incubation vehicle, a way to kind of give back to the community in a lot of ways, to foster young companies in security. I broadly transformed that pretty quickly. We 6x'd the size of the fund. Half our capital comes from Excel. They're our sole LP beyond Crowdstrike. But the biggest thing we did was we defined a very clear-cut strategy around what we want to do with the fund itself. If you think about Crowdstrike historically, it's largely been a first-party integrated company. We have our own sensors and our own cloud backend. We collect our own data, and we know what to do with our own data. But anybody who knows security knows that security is fragmented. The average enterprise has between 60 to 100 different solutions inside their environment, and oftentimes they don't talk or work together. That has to fundamentally change. So if we think about our purpose with the fund, we think capital is a really, really powerful way to help drive an ecosystem, to drive really powerful outcomes through really powerful integrated experiences. So the first thing we ever do when we look at a company in the fund itself, and the fund, by the way, now has roughly 18 portfolio companies. It's cross stage, anything from super early to super late. But the first thing that we do is we scope out an integration. We think about the outcomes that we can solve for the customer, how we make people ultimately more secure, more efficient, how we create a true, I think, technological fabric. And we think capital is a really powerful way to enable that, and that's where the fund is today. And we really focus specifically not just on, I think, individual sectors. We really think about the broad perspective of security and broader IT outcomes that we can help solve with Crowdstrike as a foundation. That's really the key for us as we think about what the fund is today and why I think it's so powerful, but more importantly, how we think about our own value creation as we think about what the fund is going to become and ultimately what it actually is today.
You know, Gore, you mentioned something. You said 6x on you. Is that how you're measured? I'm curious that, ultimately, the softball question is, why do you invest? The real answer is, how are you three measured?
Yeah, we're not here to lose money. I think, but I look at returns as an output, not necessarily an input in my calculation. We think about value creation and the idea of, hey, I have 23,000 customers as of yesterday. How do I further cement myself in that ecosystem? So I look at success as a measure of, am I solving more problems? Am I creating better outcomes through really, really deep integration? Because integration is not just a one-time thing. It's a roadmap. It's multi-year in nature, and capital creates stability, which hasn't really existed in security for a long time. I think if you look at security and why it's a unique space, vendors don't often like each other in this space. I remember being an analyst a couple of years ago. Most companies had FireEye and they had Palo Alto in the ecosystem, and they refused to talk to each other. But who suffered in the end? The customer suffered. And so for us, we really think clearly about how do we drive better ultimate value. But at the same time, I have to use my own expertise, my own knowledge base, and my own ability to discern to find the best companies, to work with the best companies, to align with the best companies. By the way, one part of our strategies, we invest in one company in one sector. So if we make a bet in a particular market, that is the bet we make. So it better be the right bet. The cost is more than just lost capital. The cost is opportunity of working more closely with other folks out there. So we really have to get it right when we think about the vendor we want to work with.
Right.
And so we go very, very deep. I also own M&A in Crowdstrike. And the reason we combine the two is because we focus so much on sourcing, so much on finding the right asset. That is so critical to what we do.
That's an interesting point about M&A, because M&A plays, it's one of the, and I want to try to get this out of our panel here, but I think one of the fears, and I want to dispel some of the fears because I think it's old world thinking, is that if you enable a corporate to invest in a company, then you limit your exit strategies, your M&A. So when they see the combination of M&A and ventures, it could be problematic. Barbara, are you concerned, or you're?
We have heard that too, but we don't. We also invest with competitors. So we've had a lot of companies that Sapphire and Workday are in together. So that usually helps when we talk to the portfolio companies. And we're really measured on how successful we are for the portfolio company. How integrated did they get into our product set? How much customer adoption and traction are they getting? We've had a lot of our portfolio companies gain 400 to 500 joint customers just through that integration, and 70% of our portfolio companies are integrated, so that is a key thing that we look for.
Does Workday measure the success of their portfolio by sales revenue?
More by customer count and by certified integration.
Impact.
Yeah, the impact that we're able to have on that portfolio company. We measure that in the terms of shared customers that we're able to provide.
Is this the same for you, Keith?
It's a little different. I think we're closer to Garen that we have a build buy partner approach where I'm responsible for M&A ventures and also technology partnerships. So what's great about having that all under one umbrella is when we meet with a company or an entrepreneur, we really have a wide range of directions we could take the conversation. A lot of instances, it's really a technology integration conversation. It's a question of how can you kind of be in our store, how can we be tied together from a platform standpoint and take that to market. The question of how do you measure the success of a corporate venture program is probably the oldest question that there is. Certainly financial return is something we look at. We're pretty rigorous about that, like I'm sure Garen and Barbara are. But the other thing that we think about is velocity with which we have been able to accelerate entry into new markets or new use cases. So ServiceNow is a platform, right? We're all about making business work and building a workflow platform across the enterprise. But there's a lot of instances where we're not going to be the ones that build or have the deep domain expertise in a particular arena. And if we can find an awesome company that we think fits with our workflow technology, we'd love to invest and then also integrate that into our platform. So, we invested in a company, I'll give you an example. We invested in a company, City Innovate, recently. They're doing government, state and local government procurement workflow. So that's a great example of where ServiceNow can be helpful, but we're not going to go build that in our own product set. We can invest in that company, we can integrate that technology into our platform, and then ultimately the success is going to be driven by when City Innovate has some exit eventually, but also by the way that we can now go to market in a new customer segment that would have been difficult for us to go penetrate outside of that.
It's interesting to seek out new markets. I think the traditional way of looking at corporate ventures is that you're going to stay inside your swim lanes, and so there's adjacencies. So there's all talk about whether it's generative AI or space or all kinds of elements. What are the new markets for each one of you in 2023? Gore, let's start with you.
Oh, that's a tough question. So when we think about investing, we think a lot about the value that we can create for a portfolio company. We're pretty maniacal about that because we live and die on reputation. That's so fundamentally critical for us. Word of mouth is, it's everything, right? The thing I learned early on when I took over the fund and really kind of incubated it was that CVC isn't a love term in the Valley, that a lot of times people see it as a science project, a nice to have, a boasting project for certain companies. But for us, we set out to do something really, really different, which is to really make it hyper strategic to Crowdstrike. So because of that, we have to think really, really clearly about the outcomes that we can deliver and are being delivered to us from relevant investments and relevant partnerships. That being said, the really cool part about investing is that we can invest in stories that are adjacent, that aren't necessarily stories that are directly aligned to security, for example. So we've invested in stories like Cribble that are a data pipelining company, right? That actually serve as a conduit or an intermediary between our data and another backend or even our own backend in LogScale. And that's not a security company. So we think oftentimes about unique and really bespoke outcomes when we think about net new spaces. Obviously, AI is a big space and a big name right now in just across tech. It's not that new necessarily in security. We've talked about ML/AI for a long time. So we're a little bit cautious there. That being said, I think there are really novel ways to leverage new technologies to solve problems that we just didn't solve all that well beforehand. So a good example is how do you solve behavioral risk? Really, really difficult. We can baseline malware. We can't necessarily baseline human behavior. That's really, really hard. So how do you stop things like business email compromise at scale efficiently? It's really, really, really tough because let's say it's a real email from your CFO. You don't want to stop that. But let's say somebody trying to siphon off $1 million into an offshore bank account, that you do want to stop. So really, really, really nuanced and really tricky. The things we think the most about, though, and the things that we try to align to, are we think technology is the confluence of output or efficiency coupled with disruption. In security, it's efficacy and disruption. So when we look at technologies, we try to apply that same lens. And forgive me, I have an economics degree by background, so I always return to equilibrium, but we think about the point of equilibrium between the notion of efficacy and disruption in any technology that we look at, regardless of what space it's in.
How about you, Barbary?
Yeah, so we really amended our charter recently to go beyond complementary adjacent markets to look at transformative. And we definitely see generative AI as a very transformative technology for the Office of the CHRO and also for the Office of the CFO. So recently we've made some investments in Sana Labs, which is using generative AI to create learning content and knowledge and bring that together and create a new type of learning platform. So we're very excited about that. And then another company called Adept AI that is coming to market with a new model, so text to action. And we think that could be really powerful since we are HR and financial transactions to automate that and provide new levels of productivity. So really kind of looking at those transformative trends in the market.
I'll maybe share a slightly different view as it relates to AI and generative AI in the sense that we're still a little undecided on whether it's practical for a large enterprise software company to use venture balance sheet dollars to actually integrate that type of technology into our platform. Like, this is the challenge for us. So we're very committed to having one common engineering platform. It's part of the way that the company's been able to scale and how we were able to launch so many new workflow products so quickly and so efficiently. So actually, I think generative AI is a place that we're spending a lot of time looking at the options. We're very intrigued by some of the picks and shovels related technologies where you can actually, use maybe a smaller set of data to drive more efficient, chatbot interactions or things like that. Because in enterprise, you're not often using the same corpus of data as Google or a Facebook or Meta. You're using a smaller just quantum of data, so you've got to derive a different amount of insight. But one of the things that we think a lot about is, what do we want to kind of build into our platform from an engineering standpoint, and what do we want to kind of integrate in from the outside? And so this is actually an area where a couple years ago we acquired a company, Element AI, that brought us close to 200 really smart PhD caliber AI and machine learning engineers, and they've actually been building a lot of that capability into our platform. So I think it's a good question just specifically about generative AI and machine learning, because larger enterprise companies have to kind of decide how they want to tackle that, right? But to answer your first point, there's a lot of big topics that me and my team spend a lot of time around. We're always kind of mapping landscapes and thinking about innovation areas. So within our core capability of IT workflows, DevOps, public cloud, security are all things we're spending a lot of time thinking about. And then one of the newer markets for us that's a real high growth segment is customer service and customer operations. And there's been a ton of innovation around how you engage with customers across multiple channels, how you drive insight and engagement in customer service. And so that's an area where we're spending time from a venture standpoint as well.
It's interesting, your comments about generative AI goes to kind of the timing of the market, whether it's early, what time. It seems to me, or I think to all of us in the audience, that what corporate venture capital has that the traditional institutional ventures don't have is this real superior market insight that should, in theory, help out on the timing of markets because of your access to the Global 2000. Do you feel that play out, Gord?
Yeah, I think maybe yes, but in a different way. And if you think about security is a market that's fundamentally built on disruption, right? So if you look at Crowdstrike today, we have 17.7% market share in modern endpoint. You go back 10 years, that was Symantec and McAfee, right? So this is a market that's fundamentally built on disruption. You look at Palo Alto Networks. Before them, that was Checkpoint. They were the market leader, right? And GFW took over, stateful firewall, right? This is a market that's built on disruption and has been throughout its short history. So when we think a lot about investing as well, it gives us a very clear lens on what could be disruptive, not necessarily to us, but to the broader space, right? If you think about security, you're dealing with a human adversary. So techniques and tactics always change. You have to consistently evolve your platform and your solution. And as we expand the threat plane, as we adopt new technologies, we have to think about what's fundamentally on the horizon, what isn't necessarily working well today that could be replaced by a better solution. And we spend a lot of time focused at the ground level of this market. I spend probably a month and a half a year in Israel alone just looking at new technology, because they're thinking about what problems maybe don't exist today or are small today but could be meaningful in the future. So we think so much about this notion of disruption because we understand that we ourselves were a disruptive force in a lot of ways. And we think a lot about that as, in security, it's got a lot of rationality to it. At the end of the day, if there's a better, more efficient, more effective, easy to deploy solution that solves a problem in a better way, people are going to look at it. We know that. We saw that firsthand and we benefited from it. So we spend a lot of time thinking about that when we think about the notion of where we focus on at the super early stage, because small can get very big in this space and faster than anybody really thinks about.
Yeah. You brought up another important point, Israel and all the different Silicon Valleys around the world that have developed. How are you looking globally at investments? Barbara?
Yeah, that's something that we're really working to expand. So we do have companies around the globe that we've invested in, but our team is all located here in North America, and we're thinking of branching out so that we have more of a global feel to it. So that's how we're handling it.
Keith?
Yeah, there's a lot of innovation in North America, but there's also a ton of innovation happening around the rest of the globe. I think for most strategics, though, and you think about being an investor even in general, there's real structural challenges, right? There's sourcing issues. It's hard to go find those companies that are really great without getting on a plane or having somebody on the ground. That's why you find a lot of companies, in the case of Israel, if you're in security, you say, we've got to hire somebody and put them in Israel because we need to be there to have our pulse in that market. But I think also there are the follow-on questions as an investor that corporates think about in the same way that financial investors think about. So in other words, who are going to be my co-investors? How am I going to be able to help add value to this company if I go invest in a company in Germany or Scandinavia or South Asia? Can I help with customer introductions in that market? Can I help with management team hiring decisions in that market? So depending on how your network is built and developed as a strategic, you may feel like you can add value in the same way that a financial investor would. But I think we're also cognizant of the fact that we don't want to have orphan companies out there in other parts of the world that we can't help. We have been active. That said, we have been pretty active in Europe. We've looked at a couple things in Israel. We have one or two companies that have engineering presence in Israel, but aren't necessarily based there from a management team standpoint. Asia, I think, has always been more of a challenge historically.
We talked to, you all heard me say that pivot or shift, at least surprising to me, maybe not to you, of shifting to early stage. The corporates shifting 62% last year. What are you guys doing? Are you mapping to that early stage, or where are you at, Barbara?
Yeah, we're early stage, Series A, Series B. We're looking for good product market fit is really key. And then synergies with our target market and target buyers, which is Office of the CFO, Office of the CHRO, and then the CIO with the emerging technologies to support those areas. So that's very much one of the benefits, back to your earlier question, Tom, of being a corporate is we can make bets in these innovative technologies. We're not required to make a financial return. Now, we don't want to lose money, and we are looking at the financial returns, and we've done quite well at Workday. But really, it allows us, and we've doubled down, we just doubled our fund, so we're a $500 million fund now, to allow us to bring those learnings back to our organization and to see around the corners, really look for what could disrupt Workday. And that's where we definitely see this huge technology shift with generative AI. It is definitely changing the market, and so making sure that we bring those learnings back to the market.
So I want to follow up on that, because you just threw in there that you added $250 million of investment. Are you bullish going into 2023 in terms of investing more in 2023 than you may have done in 2022?
I think 2021 was the record year for us and everyone else. We had as much net new investments as we had on follow-on. I think we're looking for making more pragmatic and careful but transformative bets. So they're smaller. We made bigger bets before, and now we're making smaller but more bets and trying to get into what we think all the transformative trends are that could be in. But we will definitely be slower in our capital investments than we were in 2021.
You know, I think that it's been interesting the last several years because, you know, I'm just turning over that data point in your mind. So first of all, to answer your question about stage, we're stage agnostic. You know, I don't think we're as comfortable investing pre-product because there's not a lot of value necessarily that we can add at that stage. But as soon as you've got something that you can sell to customers or demo, we're willing to take a look. And we've done, you know, check sizes that are under $1 million, and we've done checks that are, you know, $10 to $20 million. So from a stage standpoint, there's flexibility there. But I actually think if you look back, and we've talked a lot about this internally with our management team and even our board, if you look back over the last, say, 5 years, there's a bunch of corporate investors who actually ended up driving a lot of financial return from a cash flow standpoint for their companies. And while that's great, we don't ever aspire to be in that position, right? I don't want our CFO calling me up when we get to the end of the quarter and saying, what are you going to do to help me hit our number this quarter because the sales team hasn't delivered? Our focus is always on being smart and being diligent and being very precise in the way we invest. So I don't think you'll ever see us have at ServiceNow a portfolio of hundreds of companies and billions of dollars. We're always thinking about how we accelerate our platform and use our global 2,000 customer base to drive value and insight for the companies we invest in.
Yeah, we're market and stage agnostic, actually. We did, I think, 10 net new money investments last year alone. And people get really confused because they'll see a seed stage deal for a stealth company, and then they'll see like a pre-IPO late stage investment. They're like, you know, what's your strategy? And their strategy is simple. Like we're trying to create solutions and integrated solutions. And if the best way to do that is with a seed company, then great. I love doing seed stage investments because I love dealing with young entrepreneurs. I love incubating technology, and I love bringing them into the fold and helping them at the same time. Some markets are a lot more mature than others, and it doesn't make sense to do a seed stage investment in that regard. I think if you look at us, we're not incented to transact, so we don't set a path for any particular year. We think this year could be another really busy year for us because there's just a lot of really interesting new technologies out there that we want to be a part of and we want to be close to, and we're not going to use, you know, market conditions as a way to say, you know, hey, no, we shouldn't do this right now because you might miss an opportunity. At the same time, we're not blind. We'll lay in more structure and we'll likely get better terms and more ownership, but we don't let that stop us from pursuing really interesting ideas and really interesting investments. And I would actually argue that in this market, it's probably better for me because I can actually do more work.
Yeah. And
people actually see my value. It's no longer, hey, you've got an hour to make a call, round's 80 million oversubscribed, and you know, like you want in, yes or no? Like, what's the company again? Those days are done, which is great. I actually really appreciate that. So for us, you know, I actually see a lot of opportunity. I think that when I look at the net return we get that goes well beyond the notion of capital return, it's phenomenal. And I think we continue to be reaffirmed in our strategy.
For you know, I have to ask this question after 43 years as a founder. I have to ask a founder question because on one hand, the three of you, your companies could be game changers for being on the cap table of portfolio companies, market makers to some degree. But there also is this risk of death by meeting and all kinds of other issues. What are your lessons learned? What's your advice to founders that might be coming into your portfolio? How would you advise, Barbara?
Yeah, what we try to do is have a white glove relationship and service for all the founders. So we take this very serious. When we invest in the portfolio company, we assign an executive sponsor. I'm an executive sponsor on a lot of the investments that I brought in, but that's really important to make sure that we are understanding what is the founder going through and how best to support them. They'll have different challenges as they go through the different stages. And we just created a executive advisory network within all of our Workday organizations so that if they're being challenged with enterprise sales, we can get them to the right experts to help them with enterprise sales. If they're being challenged with how to show a value proposition, we can get them with the right marketing person. So we really touch base with those founders on a frequent basis based on what they are willing and wanting to do. Because again, we know how valuable their time is and how important it is to respect that, but really try to give them whatever advice or knowledge or resources that they need to be the most successful and check in with them on a regular basis.
Keith,
So death by 1,000 cuts, Tom, you mentioned it a couple of times. So I'm feeling like there's probably some scar tissue there in the past. I think it's a fair question. Like, we've all found ourselves in meetings and Zoom calls in the last couple of years, more maybe than we needed. But I think the one question that entrepreneurs should ask is simple. It's, who's the person that I'm going to be working with when this investment closes? And I think it's really important, and Gary, you mentioned this, reputation is something we care about. That's a personal thing. Brand is something we care about. And having a common alignment between the person that you're going to work with after the deal closes and what you want to get out of the relationship is super critical.
Yeah, two quick things. One, focus on the integration and the outcome, because oftentimes we'll make an introduction and the customer's like, yeah, that's great, but what do I get out of this? Beyond your validation, what am I actually getting out of this? Why do I get better value from this solution by working together with Crowdstrike? That's one, and a lot of companies try to fast forward and skip that, and I say do not do that, no matter how small or big you are. I think that is so critical. And then the second piece is, don't rush for introductions when you're not ready. You have one chance to make a first impression. If you rush for an intro to a Fortune 500 CISO and you blow it, that first impression sticks with you forever. And it takes a year plus to come back in and say, like, no, we've gotten better. So wait till you're actually ready for those introductions. Those are really, really key. I know a lot of us want to go out there and we want to get deals done. Deal is great, renewal is even better. And make sure you can actually deliver on the value before you push for these things. So those are the two big things that I certainly espouse.
Great advice. We're at the bottom of the hour, or top of the hour, I guess. I want to thank you, Gore.
Thank you.
Keith.
Thanks.
Barbary, my friend. And by the way, happy International Women's Day.
Thank you, Tom.
And hopefully next year we will elevate the corporate venture capital around inclusion so that it's 4 women up here instead of 3 guys and a woman. But to all the women founders and to all the investors, happy International Women's Day. And thank you to the Montgomery Conference. Congratulations on the 20th anniversary. And thank you all for joining us this early in the morning.
Thank you.